Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Wednesday FOMC morning. So yes, Jerome Powell will be on the mic at 2:30. The FOMC statement and rate decision will be at 2. So let's tackle the first thing, which is this decision on rates. This has not been as drama filled as obviously television analysts would have you believe. For weeks now, it has been a hold. So let me explain this data so everyone can understand how best to use it and how to shut out the noise, right? So first of all, we can speculate. So if I were to right now at 9:01 a.m. say there is a chance for a cut, saying that would be very disingenuous because it's a 1% probability. So the percentages do matter. It is 99% probability that the Federal Reserve is going to hold. Now, if Jerome looks at what expectations are, and let's say they really don't want to cut, not yet, there is no pressure on them to do anything. So today will be a hold. But we know that it's not necessarily the action as to whether or not they cut that moves the market, because that's where that 2:30 press conference becomes so important. The statement is pretty important, but remember the statement, it's really interesting. The statement is basically a fixed document. So at some point in time, whatever the statement was, and it just sort of grows, but it's only a matter of sentences either being added, one or two sentences, or sentences being deleted, or a word within an existing sentence being changed. So if you want to know what I'm talking about, there's a cool free tool called the WSJ Tracker. Right, so this Wall Street Journal Fed Statement Tracker. If you Google that, you can see what I Googled there. Click on that, and what you're going to get is the statement that we saw in March. So notice they deleted some sentences, they changed a couple words, right? This is the same document that just gets adjusted. So it's like getting a haircut, right? Still the same head of hair, but you're not really going to see anything massively different. It's not as if they're going to rebuild all 1, 2, 3, 4, 5 of these paragraphs. It's this kind of nuanced updates. All right. So with that being said, this is what we're going to get at 2 o'clock. And instantly there will be a reaction. Now, will there be some disappointment that they didn't cut? Look, no one ever said the markets are smart. They're not. They're a reflection of us. And well, you might say, Rog, are we dumb? Well, a person is smart. People are dumb. And you know what I'm saying. When you put a group of people together and they come up with bunches of opinions, there's going to be a little bit of a tantrum, even though it's 99% expected that they're not going to cut, right? This is the game that we've chosen to play. And it's a fun one. It's a psychological one, right? So now that we have that out of the way, that's May. Really, the conversation isn't about May anymore. May's discounted. Stick a fork in May. It's done, right? This is where it gets interesting. So based on the Fed statement tracker, the thing that I just showed you, and now we go out to June and July. Those are the next two Fed meetings. So when I think about June 18, there is, at the moment, and I will check this again around 1, just before 2 o'clock, there's only about a 28.6% expectation for the cut. This is the cut column, the 25 basis points or quarter point cut. This is the hold column. So right now it's 70%. Now, I'm not a mathematician, but I think 70 is greater than 28.6. All right. So it's more probable that we're going to hold. Now, as Jerome talks at 2:30, this column could continue to increase in size, or this column could increase in size. But if this column, the hold column, is less probable, right, this will then increase. That's just the way the game works. So it's almost as if it's being siphoned out of one and into the other. So right now, to say there's a chance that we could get a cut in May and another cut in June, while possible, it's not probable as the data stands right now. And that moves us out to the third month that I'm going to look at, which is July. July gets interesting because if you look at July, this is the first time where the cut column and a column that presumes that we've cut in June and we'll cut again in, so this is really a 2-cut column, one in June and then another in July. This is the 1-cut column, right? This is going to be the first quarter point cut of the year. That's 55%. That's probable. Okay. The next probability is we do nothing, right? And then the next probability is that this will be the second cut, June and July. And this is the way the game is played. Now, if this were the way they discuss it on financial television, this would be, as we just had, a 2-minute discussion. But they can't do that, can they? That's not all that interesting. Follow the data, be rational, take the emotion out of it. Oh, no. They're betting on the emotion. They're betting that everyone's going to pay attention to the noise. Right now, what's noise? It's politics. You know how I know a bad trader? They're more obsessed about the politics and not the actual trades. And, it's an easy thing to get caught up in. News knows this. Television knows this. So rather than getting caught up in the news and the headlines and the politics of it, we'll just trade what we see and not what we think. That is your macroeconomic decoder ring. What is the Federal Reserve going to do? There is no macro that is more important than that. Not even inflation, Rog? No, because we care about inflation because they do. Not even employment, Rog? No, because we care about employment because they do. What is on Jerome Powell's to-do list? That's what we care about. And all these little metrics. And by the way, earnings is not a macro. FOMC could care less about earnings. That's a stock-specific volatility event. But in terms of what the Federal Reserve is going to do, that's what's most probable. And I'll tell you, you might say, Rog, that's cute and all. What is it? They're Fed fund futures. Would anyone disagree that the S&P is trading at 56.37 right now? No, this is the S&P futures reflecting what the broader opinion of the S&P is. Well, Fed fund futures work the same way. It's a futures contract like we would have one for gold or like we would have one for crude that's making a bet on, speculating on what the Federal Reserve is going to do. So just like I would trust gold futures, I'll trust those Fed fund futures. And if nothing else, it's data. Again, we can look at a rate of change. We can look at highs and lows. We can look at the general trend of things. And that's where, again, if you want to shut the noise out, the brain's going to want something to glom onto. Replace it with data. That's how you make great trades. And, look, you might say, okay, Rog, that's all interesting. What do you have going to the Federal Reserve today? I have actually quite a few positions. These are all the positions from the Sector Secrets Mastery. So one of the things that we do, just so everyone has a kind of an idea of how we operate, is kind of step one is I find a trade. And everyone can see it because I find a trade. And once I like the setup, then I send an alert. Now, an alert is not I bought it or sold it, right? An alert is this is what I want to do by Walmart 16 May 90 calls once the underlying stock reaches this price, right? So I send an alert. It's like a GPS. Am I telling you turn right now or am I telling you turn right in a quarter mile, right? I'm a much bigger fan of the latter. Hey, in a quarter mile, I'm going to turn right. Hey, if Walmart reaches $90.05, I want to buy the 90 call, right? That alert gets sent out. Then the next thing is we're going to place an alert. Now, if you like the trade, because this is not a blind trade along, let me burst a bubble here. I know, Rog, so much positivity. I haven't even drank my coffee yet. So, okay, Rog, wait a minute. You're not going to tell us when you get in? No, I'm going to tell you what I'm looking at beforehand. Why is that important? Is this trade something I like or understand? Is this a trade that the budget works for me? I bought gold calls at $6. For some traders, that might be in a smaller account. That might be a little spendy. For others, you're going to have to sit back and say, Rog, yeah, you might buy 20 of those. I might buy 2, right? So this allows you some time to position size. What a concept. Manage risk and understanding position size before we get into a trade. Exactly, right? So by placing an alert, you've got my trade idea. If you like it, you can say, you know what, I'll follow along. So now, based on the alert where I tell you which price I want to buy at, you can go tell your TradingView, your Thinkorswim, your Tasty, your Interactive, whatever. Hey, let me know when price gets down to that level, and then I'll make a decision. Each alert has risk associated with it. So I'll tell you what my stop loss is, and I'll tell you what my target is. So it's a full blueprint. I'm not just telling you I got in and I'll let you know when I get out. I'm telling you when I'm going to get in before and when I'm going to get out. So case in point, this morning, I think Kroger is kind of close to our target. If I pre-market, it may be a little presumptuous to assume we'll still be there. But yesterday, I sent out an alert letting traders know when Kroger, right, when and if Kroger reaches 73.50. So this is one of the trades that we have on right now. We bought Kroger, if you remember from this list here, 16 May, 70 call. I paid 160 for it. And I already scaled out once at 230. I'd like to scale out again. That's going to be at this resistance at 73.50. I could have gone with 73.60. I wanted to work the major psychological level. And that's what I'm looking for. So where are we pre-market right now? Okay, Kroger is, survey says, it was up there for a brief period of time. If that's some foreshadowing, a harbinger to what's to come, hey, I'll take it. This is a pretty heavily weighted stock in the Invesco Food and Beverage ETF, which is a really interesting one right now. So you can see we're hovering right in that area. I'm 6 cents, give or take, about 10 cents from my first target. So by knowing the target ahead of time, when we ping 73.50 after the bell, that alert should go off. So I hope this is not just an insight into how I teach traders how to trade in the Sector Secrets Mastery, but ideally, whatever your process is and whatever your trade ideas are, know what you're going to buy, know when you're going to buy it, because now is not a price, right? And then know your target and know your risk. And then after that, it's up to the market. After that, we embrace the only truth that we are all within. Whatever happens next, we don't know, but we have contingencies. One contingency is the kind we don't like. I get stopped out. It happens. And the other contingency is we hit our target. That's the one we want. But again, we have a plan for either way that we make before we get even into the trade. And that's where a lot of traders struggle, because there is a phenomenon known as I have an open trade insanity. How many of us have thought about a trade and we have a great plan, and as soon as we get in, that rational part of our brain, I am pretty sure as soon as we have a number of open positions, especially open positions in size, the frontal lobe just shuts off. Now we're all just back of the brain, lizard brain stuff. And that's why it's so hard to manage trades. You might say, Rog, I had a really good plan. What happened? My emotions took over. Yeah, the frontal lobe shut off and the lizard brain took over. So the way that we protect ourselves from that trade-induced lobotomy is that we have the plan, written down or on the alert in the room, or even better, you place those alerts. And on a day like today, we have FOMC, we could see a lot of volatility. There's a lot of positions we're managing, and I definitely want to make sure I protected myself by trailing stops, knowing these targets and paying myself when I can, not when I have to. All right, so first question from Ren this morning. If you have any questions, type them on in. Federal Reserve's at 2 p.m. Eastern, presser's at 2:30. The presser is the more important event, and we are not expecting a quarter-point cut. All right, so any thoughts on a good entry point for longer-term investment in XOM? Yeah, this is when we're looking at a couple of these, Ren. Yesterday, we in the Sector Secrets Mastery for our longer-term position trade session that we do first Tuesday of every month. It's something we do in the Mastery, which is longer term, months, 6 months minimum to years, either via shares, which is my preference, or leaps, which has been a very popular choice for a lot of our traders. That's what we do. I'm not near the level yet, but it's going to be around 100, Ren. But I would also mention, keep an eye on Chevron and keep an eye on XLE. XLE, if I'm going to look at this and consider not just Exxon, because there's a nice dividend here, right? One of the things that I will look at when I'm trying to determine leaps versus shares is, well, is this the kind of symbol that I would like to enjoy the dividend payout on? Is this something that I might hold for 5-6 years if possible, as opposed to maybe a 1 to 2 year kind of leap based longer term trade? And it is a longer term trade. It's a strategy that everyone can do. And even if I can say so, and I will, it's a strategy that everyone should understand. I don't call it investing. I don't really look at investing the same way. I'm a trader. I think a lot of you are too. So it's easier for me to go with the way I'm wired, which is, hey, lengthen the time frame, have a target, have a timeline, know what my stop losses are, and then treat it as a trade. And you might say, Rob, well, how long can some of these trades last? Well, in the Sector Secrets Mastery, we have some trades that are position trades that have been on for almost 3 years. Right? We bought XLK back in 2022. For fun, go look at where we were in 2022 after the dip. So we've got some of those positions now for almost 3 years. I've got position trades in accounts that I've had for over 20 years. So the word trade does not insinuate short term. The word trade to me insinuates a different kind of plan as opposed to, say, an investing plan. And I'm definitely a trader. So it's good. It's easier for me to go for best foot forward. So that's what I would look at there. And Ren, yeah, if you're looking at shares, totally fine. You know, some of our members do a combination of shares and calls. So I'll give you an example. We did a TMUS trade in the, I'm trying to remember, position trade in the room. We alerted this out. And I'm looking at my notes from yesterday. So TMUS was a trade that we set up to buy at 235 and 230. And for a lot of traders, buying 10, 20, 100 shares of a $235 stock is not in the cards. And it may not even be something that they want to do, even though it's a pretty decent little dividend payout. Okay. So then what they did, our members said, look, let's go out to March 2026, right? Let's go out to a year out from basically when we sent the alert and buy the 230 calls. And that's what a lot of our traders did. And on average, they paid around $2,700 or $2,800. And this is knocking on the door $4,000. So they bought an option instead of the share with the same trigger. And they bought things for approximately 28, I think 26 or 2,700. I didn't buy the leap. I bought the shares. So some of them said, hey, Rog, we didn't buy the $235 stock, but we bought the 230 strike for next March, paid about roughly $2,700 for it. Now it's knocking on the door of $4,000. They love it. They have approximately 10 months, and they know if the TMUS trend continues higher, that option will continue to gain value. It's a nice trade with far less capital, needing that kind of capital to move around 100 shares of, $200 plus stock. So there's always a choice to do a little bit of both. Exxon's probably a whole lot easier to focus on shares. It's only $100, but I would also mention, you could look at a $100 strike for 12 months out from that trigger date. Those are things that we do every Tuesday. And we have a pretty prolific portfolio of these longer term position trades that don't need us to babysit them every day. I look at these about once a week. I don't look at these every day. This allows me to have this third style working for me. I mean, who doesn't want to buy something for $2,700 and see it trading at 4,000, maybe more if the trend continues, right? So that's a really powerful and less time intensive trading style. We have our swing trading and we have our day trading, and even some of our traders scalp. So they're up to 4 styles, but if we can compartmentalize, we can do all of it. And that's really, for me, the key to keeping my pipeline of opportunity full as a trader. All right. So Ren, thank you for the question on Exxon. So as we wrap up, yes, we're looking at this decision from the Federal Reserve being just really no change on rates. Also, it's the press conference that will be likely moving expectations for June and July cuts. If you're looking for this graph, all you need to do is Google CME, Chicago Mercantile Exchange, by the way, CME Fed Watch, and you'll get this link. Check it out. This is your macroeconomic decoder ring as we go into the Federal Reserve event today. All right, gang, be good to each other. I'll see you tomorrow. Same time, same station.